Good morning. Welcome to this webcast from the Association of Corporate Treasurers with Paul Fisher, Executive Director for Markets at the Bank of England and an Honorary Fellow of the ACT to boot. Paul joined the bank after an academic career. He is, I should add, Chairman of the IFS School of Finance that grew out of and now includes the Chartered Institute of Bankers. We're here to talk about the Bank of England's Funding for Lending scheme announced last month, and in particular, I hope we'll hear about implications for non-financial businesses in due course. I'd like to thank all of you following us online and to remind you that you can easily submit questions for Paul from the screen where you can see the few slides we're using today. The link was in the email. Your questions will appear live on screens in front of me so that I can put them to Paul, and your questions will shape the webinar after Paul spends a few minutes explaining the FFL scheme, the thinking behind it, and hopes for what it can achieve. Paul.
Thank you, John. And thank you very much, everybody, for your time this morning. I'd like to start just by setting out the context for the Funding for Lending scheme. Why are we doing it, what we hope to achieve, and some of the main points behind the design features of the scheme. First of all, as you'll all be aware, the UK economy has not been growing anywhere near its trend rate of growth. In fact, it's been basically flat for the last 2 years. One of the factors contributing to that, but only one, is that the supply of credit to the economy has clearly been impaired. Bank lending in total to UK businesses and households has been flat to falling for the last 3 years, and that's showing in this growth of lending chart that's shown up on the screens. The banking system, by now, should have been in a position to have repaired itself and be getting on with its job of lending to the economy. It probably would have done so had it not been for the deepening of the crisis in Europe. The UK banks have done quite a lot of work to repair their capital and liquidity positions, for example, and get into better shape. But the crisis in Europe has meant that their funding costs have continued to be elevated. And whereas we would have expected interest rates to be flat or falling, given what we've done with monetary policy, over the last year or so, rates of lending to businesses and for mortgages have actually gone up to reflect the higher funding costs of the banks. And so we decided now to try and take action to directly affect the supply of credit to the economy. And the Funding for Lending scheme has been designed to support the economy. It hasn't been designed to support the banks. I think that's one of the fundamental design points to bear in mind. All of the decisions we've taken around the design of the scheme were with that sole objective in mind. And the basic idea of the scheme is to incentivize the banks to lend through providing them with cheaper funding. And we can reduce their cost of funding by around 1 to 2 percentage points relative to their market cost. But we're going to do that in a way which is linked to their success in lending. And so the more they lend, the better the terms and the greater the access they can get to that cheaper funding. So we're trying to make the banks do what we want them to do by making it in their own commercial interest to do so. Now, the state of the UK banking sector is such that it is what we would call oligopolistic. i.e., there are 6 big lenders to the UK economy and quite a big gap down to number 7. That lack of competition has a distinct effect on the economy and also means we have to reflect in the scheme the different starting points of all those big 6 lenders in particular. At the same time, we also want to encourage smaller lenders, smaller banks and the building societies to pick up some lending growth if we can. But of those big 6 banks, it's easiest to think of splitting them into 2 groups, and I'm not going to name names this morning. Those who are in a strong position, who could simply expand their lending given the right conditions, and those who for various reasons would have contracted their lending had we done nothing. And our starting point was an outlook for lending where we thought it was more likely that aggregate lending would contract over the foreseeable future than to expand. And so actually it was heading in the wrong direction. But we've tried to design the scheme so that all of the banks, whatever their initial starting point, they can take part and get the cheaper funding linked to more lending. So actually the way we did this was to say that every bank could have a 5% of their initial stock of lending accessed at cheap rates, just a fee of 25 basis points, for which they can give us illiquid assets. Typically they will be posting us portfolios of lending loans to the bank as collateral, and we will give them short-term treasury bills for a fee of 25 basis points. They can either hold those treasury bills as liquid assets, enabling them to lend more, or if they really needed to turn them into cash, they could do that in the market at bank rate, or they could come to us in our normal operations and get them close to bank rate. And so essentially we're providing the equivalent of cash at around 75 basis points to the banks. Now those banks who are able to expand their lending will get that initial 5% allocation plus any increase, an amount equivalent to any increase in lending they are able to do. So if a bank manages to grow its lending by 10%, they will get 15% cheap funding, and it's just additive. So they have an incentive to lend more in order to get access to this cheap funding. For those banks who, for various reasons, were having to shrink their lending, what we've said they can still get the 5% basic allocation, but the fee will go up the more they shrink their balance sheets. And so the idea here is to incentivize them to shrink their balance sheets by less, i.e. to lend more than they would have done. And some of the banks were in a difficult position because, for example, a couple of them were under instructions from the European Commission to reduce certain amounts of their lending in return for receiving state aid. And so some of this is not exactly under those banks' entire control. But we think the scheme we've come up with is relatively simple for the banks. We are not tying them in knots in order to get access to money. They have an 18-month window in which to draw down. We've advised them to spread that out so it doesn't cause a problem at the end of the scheme. They can have the money for 4 years. Although we're lending them 9-month treasury bills, we will automatically roll those treasury bills for them. So effectively they will be getting that cheap lending for 4 years. And they can get that over an 18-month period. So the life of the scheme in total will be around 5.5 years. Now, because this is not a scheme to support the banks, it's a scheme to support the economy, we have taken a different approach to disclosure. Usually, we are very reticent about naming individual banks in terms of the use of our schemes because we don't want to risk financial instability. In this case, we will be disclosing all the banks that have signed up for the scheme, their initial stocks of lending, and the amount they lend extra under the scheme, or the stock of lending they do. So you'll be able to see what each bank is doing. The banks themselves will have to explain how that corresponded with what they would have done in the absence of the scheme. If some banks were planning to cut lending, they will have to explain that they have lent more than they would have done. Other banks, it will be more straightforward, but that will be a matter for them. We will publish bank by bank how much they are borrowing from the scheme and how much lending they are doing. And that's a condition of them signing up from the scheme. We expect them to take some time to change their lending approach and to get new products into place. We've seen an initial flurry of announcements for changing terms and conditions or fees in order to take advantage of the scheme. But this isn't a sprint. We've likened it more to a middle distance race. We don't want them to take so long to use it that it has no effect. The need for this credit is now. But at the same time, it does take them a while to find who to lend to get that money out of the door and to make new agreements. So we're not expecting this to be something which cures the economy in a few months. It's going to take a little while for it fully to work through. The banks could pass on most of the reduction in the funding costs we're giving them. That's what they would normally do. But in this case, from talking to businesses ourselves, we think the problem is as much in terms and conditions as it is in the actual lending rate. And some of the banks we've talked to have talked about how they might adjust who it is they're prepared to lend to and the terms and conditions of those loans rather than just reduce the fee. So, for example, they may lend to a customer they judged as too risky previously. They may lend to that customer now because they can earn a higher spread on the loan. So that's one way in which it may work. Of course, those banks themselves will have a strong competitive pressure put to them, partly by the disclosure arrangements, and partly because there's only so many firms out there and so many mortgages that they can lend on. And we're trying to put pressure on the banks to be competitive and get out there and lend. They will get most out of the scheme, the more lending they do. They can't afford to miss any opportunities to lend. And we're hoping that this will drive them to push money at firms a bit more than they have been doing, and in that process turn the conversation around. A number of businesses we've spoken to have been reluctant to approach the banks, partly because they think they'll get turned down, partly because it's taken a long time and the banks are putting onerous terms and conditions on. If the banks are trying to expand their lending, we hope that will change the conversation round and the firms will be beneficiaries of that rather than the banks. Now that probably sums up all the initial points I'd want to make. I'll stop there and allow plenty of time for questions. John.
Thank you very much, Paul. We do have some questions coming in indeed, but that was a very useful place to start us off, and thank you for being relatively brief. The first question here is about the bank participation, which you touched on. HSBC already says that it will not participate in FFL. It has a surplus of deposits, does not need the extra funding. Are other banks showing more enthusiasm?
Well, first of all, HSBC have actually been supportive of the scheme, both in private and in public comments. They think it's a good scheme that's worthwhile. They haven't totally ruled out using it in future. They've said they don't need it now because they have an excess of funding. And in their particular case, I think that's fine, but they are a special case. What's happened through the crisis is that a few banks have become what we call money centre banks, attracting everybody's cash because they're seen as the best credit risk. And it's not surprising that HSBC in that case have said they don't need the extra funding, but they are holding it open. The other banks are generally expected to use the scheme. We're expecting all of the big players to sign up apart from HSBC. And we're hoping to get the vast majority of banks and building societies in the UK signed up for the scheme. It will take a bit of time for them to do that. There are terms and conditions they have to sign up to, and they have to do their own legal due diligence and get themselves comfortable, for example, with our disclosure policies. But we haven't really met anybody who says they want to keep away from the scheme entirely or that it's a bad idea from their point of view.
Good. We have a question from Paul Riley at Leeds Building Society, who asked, did the bank consider the impact of the introduction of scheme has had on the securitisation and covered bond markets in the UK? He says primary issuance has ceased and secondary liquidity has dried up. Was that a consideration?
Well, one of the general things we're trying to do is replace expensive wholesale funding with cheaper funding from ourselves. Now, that meant that UK banks are going to be issuing a lot less debt over the next 18 months or so than they would have done, and that includes covered bonds and other securitisations. But those issues were going out at relatively elevated spreads, and that was part of the problem, giving the high funding costs to the banks. And so we are, in a way, consciously trying to replace that expensive funding with cheaper funding. Now, the effect on the market will be interesting to see. Obviously, banks will be issuing less, but demand for existing products, you would think, would go up. That could lead to less liquidity because investors will want to latch onto and hold those higher yielding assets. But my expectation over the course of time is that the greater demand for high yielding assets would lead to those funding costs coming down in the market as a result of this. Because banks are issuing less and the demand for the assets is there, we should see those elevated spreads coming down. So we're hopeful that the funding for lending scheme will actually bring down funding costs, actually across the board, but certainly in those markets.
Thank you. Another question here. Funding for lending will be accepting a wider variety of collateral, admittedly with big haircuts. Is this setting a trend here and in other applications too? And I might add that I've noticed the suggestion that the ECB and other banks, central banks in Europe, are urging for some easing of the rules on holding assets for liquidity, that sort of categorization as well. Are we seeing a general trend to what you to accept more collateral?
I think it's right that the Bank of England's collateral policy should be counter-cyclical. In times of stress, we should be being prepared to accept wider versions of collateral than we are in normal times. We still only want to accept good quality collateral, and we will always take haircuts to protect the public sector balance sheet. But we have increased our abilities to analyse collateral, and in particular now the ability to take portfolios of loans means that we aren't limited to lending to banks who happen to have portfolios of tradable securities. We can actually, in principle, lend to any bank or building society that has got a good quality loan book. And so that's an important widening of the counterparties with whom we can deal. And given the lack of competition in the UK banking sector, I think that is important. I think the other thing you referred to is the liquidity coverage ratio in particular, which is still being negotiated through Europe. I think you'll have seen from the recent Financial Policy Committee discussions there has been concern that an overly restrictive liquidity policy may have been holding back the supply of credit. I think the Financial Services Authority have addressed that. They're doing it bilaterally with individual firms because we still need the banks to keep a prudent degree of liquidity. But yes, but this is, I should say, these sort of relaxations at this stage should be seen as related to the crisis rather than as permanent changes forever.
Thank you for that. We have a question from Ivan Harkins at JCRA, who asks, how does the scheme determine that a bank has lent more than they would otherwise have done?
Well, of course, we can't say that for sure. We did have access privately to the lending plans of each of the big lenders. That information wasn't completely up to date, and because of the nature of the scheme, we couldn't go asking them for revised plans without giving the game away. But we had a pretty good idea of what each of the big six lenders was planning to do. I think they will have to explain the amount of lending they actually do under the scheme. As I say, we can see that, but the problem with any macroeconomic policy action is you never know exactly what would have happened if you hadn't undertaken the action. We're trying to change the course of the economy, and we will never know exactly what would have happened without the scheme. And in terms of an objective of the scheme, if we can get any return to a positive, sustained growth in credit to UK businesses and households, I think that would be a huge benefit relative to where we had been, as you'll have seen in that earlier chart of flat to falling lending growth.
Thank you. Well, there's always the problem of knowing what the counterfactual would have been. We have a question from John Marvel at Cash Perform Limited. He says the message is focused on banks, but little has been said about business and how they benefit from the scheme against current past lending. For instance, the credibility of banks affected by poor customer service, poor housekeeping, poor credit rating news, bad press from the EU, etc. So why should business want to obtain funding from such organisations? I mean, that's a very wide question, but see what it's driving.
First of all, we aren't in a position to make a bad bank a good bank or turn a poor customer service record into a good one. That has to be for the banks themselves. And if businesses can obtain funds from other sources, that's fine. There are actually a range of funds out there at the moment who are looking to engage in lending to businesses. And that increase in the competition for the provision of credit would be a good thing. And what you're really getting at here is that lack of competition in the current banking system. However, for many firms, particularly the very small firms, they really have no option other than access to bank credit if they want credit. There's an issue about access to equity, but that's another matter. If they want to borrow money, really the banks are the only game in town for many of those smaller businesses. And that's particularly so in certain parts of the country or countries within the UK, most notably Scotland and Northern Ireland, where competition is even less than in the rest of the UK.
That's interesting, the regional aspect there, which I must confess, sitting in London, I tend to overlook.
Well, come back, I was in Northern Ireland just a week or so ago and talked to a number of businesses there and indeed some of the banks. There they only have 4 big lenders. 2 of them are owned by Irish banks. Ulster Bank is owned by RBS, and the 4th is owned by a Danish bank. And so it's a completely different setup from the rest of the UK, and they have even more difficult problems given the property lending boom they had in Ireland, which spilled over into Northern Ireland. And so these conditions can be even more acute in different parts of the UK.
That's very interesting. Another question here. Someone quoting this morning's City AM, UBS analyst Alastair Ryan says, banks are not making profits, pay almost no dividends, and have seen cash bonuses fall by 80% or more. Higher capital ratios will have to come from smaller balance sheets. But if demand is for higher capital levels were removed, the funding for lending scheme could be a powerful tool. Is that right? Is it a condition?
Well, there is no cap on the amount that we will be providing under the funding for lending scheme, but there are natural limits. One of those is the capital that the banks have to allocate to the lending. Another is the amount of liquidity they have to hold. And the third is their ability to find businesses and homeowners to lend to. But on the capital front, what we are doing is making this particular form of lending more profitable than other activities, relatively speaking. So the banks should be prepared to switch capital from other things to this, particularly the big banks that have complex balance sheets and undertake a range of activities. For the smaller banks, there is a discussion to be had with the regulator about how much capital those banks need to hold. And we know the FSA will be taking a positive view of any extra lending that is done using the funding for lending scheme. Now, I can't say much more than that because it's a bank-by-bank discussion for the regulator to have, and it's not a matter for the FSA. But I'm hoping capital will not be an immediate constraint on lending to good quality businesses and households. These are relatively low-risk assets compared with some of the things the banks get up to, and we're hopeful that won't provide a constraint.
You said that this is partly about incentivizing the banks to do what's perceived as the right thing. So you're potentially lowering the cost of the banks as that incentive. So is that more important in its effect than them actually passing on the lower cost, but really being willing to lend?
Our target here is to increase the supply of credit. And that means the banks have got to find a way of doing that. Either they're going to need to lend to firms they would not lend to before, or they need to gain more customers by lending more cheaply or with looser terms and conditions. There's a variety of techniques they can use depending on their targets. I think they can't afford to miss up any opportunities to lend, and they will have to lend most aggressively to the credit-hungry businesses, the small, medium-sized enterprises, and to first-time buyers in the mortgage market. I think that's what they're going to be most incentivized to do. That's where the opportunities are for them to expand their lending. And if they don't do it, some other bank will, and some other bank will get the cheap funding and the increased market share.
Back to competition again. So a question from Brian Welsh. Where does the bank believe the greatest need is? I think you probably just answered that. The large and even medium-sized companies are able to access the direct loan markets, which has been very strong. Is it more the small and very small companies where the banks have been charging very high interest rates and separate significant arrangement fees? Do you think there might be a spillover into those sort of ancillary costs for those smaller companies?
I do. I think RBS originally announced that they were scrapping the arrangement fees for small business loans. And so we've already seen some change in that direction. I think the key thing here is that there are different targets, again, within the economy. The reason small businesses are important is because that's the growth engine of the economy. That's where most of the employment will get created in future. And that's what will determine the longer run growth rate of the economy. In the very short term, most of the capital spending is done by the larger businesses. And what we're really looking to do there, I think, is help to instill some confidence back into the corporate sector that the provision of credit will be there in future. in order to support their businesses if they expand. I doubt that a small change in the lending rate is going to make a big difference to those large businesses. But knowing that the supply of credit is going to be a bit more forthcoming over the next year and a half might well give them a bit more confidence to go out and expand more than they otherwise would have done.
So back to the bank's own confidence. We have another question here from Jacqueline Cook from Addleshaw Gollard, who says, could this scheme be seen as state aid under EU legislation?
We think not. We obviously had to address that up front. We had a team go over to Brussels to discuss it with them. And the way this thing works is if you're not state aid, you don't initially get a declaration that you're not state aid, but they give you an initial view, and then we might hear later. But we did design the scheme quite carefully to avoid that trap. So it's one scheme with no particular changes for any one particular bank. Now, we could have done that to target the support even more carefully, given the nature of the 6 big lenders and their different states. But we had to have a single scheme with the one set of rules. We do not have an indemnity for the government for this, so it is a central banking operation. It is not that different from what the ECB did with their long-term repo operations. The main difference is we are linking the funding support to the bank's lending, how much lending they do, whereas the ECB with ultras did not do that. But otherwise, it's a very similar sport in terms of for the banks. So we think we've taken careful steps to avoid the state aid trap, and the initial view from the EU authorities was that it would not count as state aid.
Okay, thank you. Stan Varkaloff from Lloyds asked, what has been the track record of similar schemes, if there were any, in terms of the effect on the economy? Have there been similar schemes?
I don't think there's been a scheme quite like this. I think it's relatively unique. We know the US are interested in it and looking at it. Whether it's appropriate there, I'm not sure, because their banking system is in a different state from ours. The ECB did 3-year long-term repos, again, something slightly different. So I don't think there's been anything directly like this. Certainly, we haven't come across a scheme when we were preparing it that did quite what we wanted, and so the scheme was largely built from scratch during the middle of this year.
Thank you. David McKibben from Scoop Consulting asked, does the Bank of England have in mind a percentage split between funding for working capital and funding for commercial and residential real estate? And also, are there any provisions for PNSEs trading overseas to support exporters?
No, we took the view that we were simply not in a position to try and direct the lending to any particular outcome. We could have tried to do that, but we would essentially be micromanaging the bank's assets, and I think that would have discouraged the banks from trying to access the scheme at all. We thought our best chance was to go for a simple scheme where the banks decide who they want to lend to, and after all, we've got some banks who specialise in lending to businesses and other banks who just do really mortgage lending and don't do any business lending at all. We thought we'd best leave it to them as to where the credit goes, but we would just maximise their incentive to increase aggregate lending to the economy. We thought that was the most effective way to support the economy as a whole.
Right. So, as you are looking across the economy at the macro level, we have a question from David Gregg, who asks, given Santander's recent decision to increase its SVR, what is the likelihood of the benefit cheaper money will flow to households?
I think, again, it's difficult for me to talk about an individual institution and its decisions. Different institutions, different banks, will be targeting different sectors of the economy. Some will be targeting mortgage lending and some will be targeting business lending. And if one bank, whether it's Santander or another, decides to put rates up for one part of its lending book, you have to ask what they're doing on the other part of their lending book. I'm sure there will be lots of competition for mortgage lending, even if Santander are not themselves pursuing it.
Right. So we have a question from Paul Riley at Leeds again. Would the bank ever consider more direct asset purchases, for example, in residential mortgage-backed securities, rather than providing funding via the FLS or QE through gilt purchases. I remember that in the crisis we spoke to you about the bank possibly buying bank loans directly and so on.
But we have spent quite a lot of time actually considering it and looking at it and have not decided to proceed on that basis. The problem is then you're taking the risk off of the banks onto the public sector to balance sheet in a way which makes it very difficult to return it. The advantage of buying gilts is that we get money into the economy quickly and we can reverse the process when we need to. If we bought a lot of loans or RMBS from the banks, it would be very hard for us to sell them back again. We would simply be stuck with them until they mature. And we think we can largely obtain the same benefit for the economy by lending, taking those sorts of assets as collateral rather than as purchasing them outright. Essentially, a 4-year loan is taking them as collateral is essential to a 4-year repo, i.e. with essentially buying assets for 4 years and then selling them back again. It's economically equivalent to that, except for the fact that the banks are committed to taking the assets back at the end of the period. And we think that's a better way of doing it in terms of protecting the public sector balance sheet, leaving the risk with the private sector, but still managing to get the liquidity into the system.
Right. Going back to the actual structure of the scheme, you talked about the incentive for banks to increase their total loan book against what they had previously planned as far as it's possible to determine that. We have a question from Martin Newman at VFS Financial Services who asks, bring it up again, sorry, it just disappeared. He's concerned that some banks will use it to finance investments where the decision to lend has already been made. In other words, people might be holding off waiting for this kind of scheme, I think.
Well, the scheme is now open and the banks could draw on it. So I hope they're not waiting any longer. The way we're going to measure this is we've got the initial stock of lending from the end of June, and we will look at the change in that stock of lending. So in order for the banks to improve their access to the scheme, they will need to increase their lending net compared with where they were. And so it doesn't matter whether that's existing customers or new customers, we are blind to that. And I think some firms could take this to their advantage. If you're not being offered very good rates by your existing bank, you can shop around. And for another bank, that will be considered new extra lending compared with what it was doing before. And so there's definitely an incentive here for the firms to shop around and see where they can get the best deals. Again, putting some competitive pressure on those banks to lend.
I'd make a comment on that, which is that for the smaller companies who are probably most affected by this, most banks who are already making loans to a smaller company will have restricted them from doing any business with any other bank. So it becomes a decision almost to shift their entire relationship, which is a big decision and is likely to be slow.
It does. And when I was in the East Midlands recently, I talked to about 100 firms while I was there in all. But of those, most of them had been able to get the finance they wanted, but I guess about half of the ones I spoke to individually had been able to do that only because they've been willing to change their supplier of credit. They'd gone to a new bank and managed to get a better deal. So it is something worth considering. And that partly reflects the fact that these banks are very large and the quality of regional managers and branches can differ. So you may get a better deal from a big bank in one part of the country than you do in another. So you do have to be able to shop around and get the best people to be your suppliers of credit.
Very good. Sorry, the clock is beginning to catch up on us. Perhaps one last question. It seems the monetary transmission process has been broken for the past 3 years or so. Money supply in the UK has been falling. Is FFL really going to make a difference?
I think, again, you have to think what would happen if we hadn't stepped in to do this. We were seeing a situation in which we could well see the supply of credit going down over the next couple of years. So I think it could make a big difference. But the actions of the central bank are only ever one part in a wider macroeconomic picture. We can do quite a lot of things that will stop the economy falling over, but we don't actually make anything real or produce anything real. Only real businesses do that. Only real households go out and consume. And so we can provide some conditions that are necessary for a resumption of growth, but we can't force that to happen. And that doesn't mean to say monetary policy is not powerful, but it's not like we can just pull a lever and the economy will start growing again. What we're doing is trying to provide the conditions, trying to provide the confidence, in this case, trying to provide the credit that will fuel that recovery.
Thank you. So you can lay on the party, you can't make people come.
Exactly.
Right. Well, thank you very much indeed, Paul. That's been very interesting, and certainly I understand more of the background of and intentions of the FFL scheme now. Thanks to everyone who's been listening and participating and everyone that sent in questions. I haven't been able to get to all of them, but thank you all very much. Makes a big contribution to a webinar. We've reached the limit of our time, and I'll remind you that the webinar will be available online at www.treasurers.org on Friday. If you want to review anything or to forward it, share it with a colleague, do that, by the way. I will be tweeting when it goes up on the ACT website. @JohnGrout1 is my handle. Thanks again to Paul for a very interesting exposition of FFL, and I hope this has been the first in what will turn out to be many ACT webinars. So goodbye to everybody. Thank you very much.